All right, so futures higher today. The president saying he's going to be nice when it comes to a trade deal with China. Also saying no plans to fire Jay Powell. So a lot of optimism out there. With that, what's your word of the day?
You know, it's so funny, Frank, because my word of the day is limbo. I was thinking yesterday about the limbo that we've been in during this 90-day pause. You know, perhaps the headlines you just mentioned is going to give some clarity. We'll see. I think that investors have learned that nothing is final until it's actually final in this environment. And we've been at this pause where volatility is simply higher in this regime. You know, we're very much over that 20 psychological pull in the VIX, and we'll probably still stay there even with these headlines.
All right, that's fair enough. When we're looking at the options market, how are people positioned? Are they positioned for more downside, or are people trying to look for a potential bounce? Of course, yesterday we saw a bounce. This morning looks like we're going to see a bounce. How are people positioned?
Yeah, you know, I think the last 24 hours could change things. I'll say coming into this prior to the headlines, people were still positioning for downside. They've been very concerned about what companies are saying on earnings. They've been concerned about when companies are just taking guidance and kind of throwing it out the window because they have no clarity. Again, that's why we've been in this high volatility limbo regime. And then certainly given what Trump has said, and if he gives more clarity to the idea that they could walk back tariffs from where they are at this level with China, that could certainly change. But people were positioned to the downside.
So positioned to the downside. We had a guest on earlier that cited the Bank of America Fund Manager Survey. This is the 5th most bearish that people have been, the other in 25 years, by the way, just for that time frame. The other 4 times turned out to be big-time buying opportunities like 2009 and 2022. If people are positioned in this bearish way, how does that usually play out if what we saw yesterday and what we're seeing today is sustained?
Yeah, that's such a great question. And of course, when you look to history, the past 20, 30, 50 years, typically, you know, these crises have at some point been a buying opportunity. The issue, Frank, is the timing around it, right? Like you can kind of be right on the global idea that we'll eventually have the recovery, but if you mismatch the timing, you'll still get a little bit burned. And that's what's been very painful for investment managers right now, is getting that timing right, getting that clarity when, you know, we've been in this 90-day hold. So I think we still haven't seen those bullish positioning yet. We haven't seen that change in sentiment. People, I think, are just trying to slog it through earnings season. But certainly any rhetoric like what we have seen this morning could change what the outlook is going forward.
So with that in mind, Amy, I know you don't give us a specific pick, but what's an interesting play right now for people looking to put some money to work?
Yeah, one thing we have been looking at is consumer staples. The ticker is XLP on the ETF downsides, looking at put options. And of course, I'll give the same caveat. The headlines today could change things if we get clarity. But folks have actually been flocking there, Frank, as a safe haven. And what our research analyst has actually been very concerned about is that you're actually going to see further cuts in this area as the consumer gets hit more. It's a place where the options market pricing on downside has actually been relatively inexpensive compared to other ETFs. And so that's one thing we like on a sector basis.
So price to the downside, you said, has been relatively inexpensive. I would think it would be a lot of bets for the upside, right? I mean, because people get defensive and staples are defensive.
And that's why you've seen that pricing the way it is, because people kind of think of it as this first order defensive company. And when our research analyst actually goes bottoms up and actually looks at where there should be downside revisions, he actually thinks it could still be hit given what he has seen and what he thinks management teams will do on this earnings cycle.